So for those that don't know, Jack, we met Ed in New York City. And it was by accident, right? We didn't know each other before we walked into a room. And it was something really awesome that a lot of our followers have actually seen. And we've gotten a lot of positive feedback. And I got to tell you, Ed, it was probably a bucket list for me.
Yeah, for sure.
Same with you, Jack.
Absolutely.
It was one of the coolest things. And before we get started, maybe here, you could take a look here, Ed, show you what we were doing up there. And there you are. And there's a funny story here. So, Ed, you're right when you go to press the button here to ring the bell, if you keep an eye on me, I jumped because I got so startled. And I came home. I didn't realize that happened. And the first thing my kids tell me is, "Oh, we saw you got scared. We saw you got scared." And I didn't think much of it until my wife turned around to me and said, "You realize millions of people saw that on CNBC." And then it hit me. But what a thrill. So thank you for allowing us to be part of your big day. And tell us, before we get started talking about why we were there, introduce yourself to our audience. Give us a little bit of your background.
Yeah. First off, I'll say thank you for joining us. And thank you for having me on. So my background is I am the head of ETF and funds management at Texas Capital. I've been in the ETF industry for, what month are we in? May. So a little over 19 years. My career started in ETFs back at Vanguard. To give you an idea of how long ago this was, Vanguard only had 23 funds and 8.5 billion in assets in ETFs. I joke they're just a smidge bigger today.
Yeah.
Just a touch. But back then I started out as like just anything else, like a product analyst in a sense. Worked my way up to product manager, left there, went to Russell to run ETF capital markets and analytics. For those that don't know, Russell had their own ETFs for a couple of years. They shut down the business because they wanted to sell the company. They kept their Australian ETF business, shut down their US. I went to Northern Trust to do the same role, run ETF capital markets and analytics. Spent 5 years there before I went to American Century. At American Century, I ran the ETF business. In the 5 years I was there, we grew from zero to about 27 billion before I left. And now I'm doing the same type of role, but adding in other structures besides ETFs, mutual funds, SMAs, CITs, anything that our clients feel they need in the structure that they need for Texas Capital. And so we're just at the beginning again. I feel like I hit the rewind button, started over, and was like, ooh, I just went through this.
So that's how you and I and Jack, we met you, because we were in New York City. Texas Capital had extended an invitation to us to go and celebrate the ringing of the bell for the new ETF. And lo and behold, we walk in, we see you by yourself because we got there early. That's how excited we were. We had no idea who you were. And now we find out you're the guy. You're the head ETF guy there.
I was lonely there. You came to join me because I got there so early.
Yeah. So, I mean, I want to just jump straight into this thing and talk about, all right, so tell us about that ETF that you're launching and why you invited us and other folks and the whole idea behind that fund.
Yeah, so the fund we're talking about, ticker is TXSS. My salespeople joke it's a mouthful. I have fun with it because he stumbles over the double S. I show my age. I just tell him to call it the SS Minnow.
There you go.
But it is a small cap version of our other fund, which the ticker is TXS. Basically, it's centered around companies headquartered in Texas, right? What's different about that is, one, you have to be headquartered here. Two, in order to be included in the fund, the small cap version, you can't be in the largest 800 securities. So if you are, you're not small cap anymore. So we take you out. After that, there's two criteria. You have to have $100 million in free float shares, and you have to trade on the rebalance reconstitution date $1 million a day going back 90 days. So the stock is liquid enough to include. That's it. They're all included. Now, what makes it another first, besides being Texas, is it's the only ETF besides our sister one. We have the only ETFs in the industry that will sector weight by their impact to the state's GDP. So the BEA will publish every quarter what sectors have an impact and the percent of impact on the state's GDP. And that is how we weight our sectors in the fund. And then from there, if you're included, you basically just get thrown in, like you could have 90 companies make it up that fall into a specific sector, and that sector is 18%, it doesn't matter how many companies are in there. It's still only going to be 18%, but all 90 companies would then be market cap weighted within that 18%.
Okay. So if I'm looking at this thing and I'm asking myself, how is this different than some of the larger funds out there?
Yeah. Well, we're new and cute. No. Realistically, what makes it different, one is that sector weighting. Two, it revolves around how the companies, the environment they operate in. So let's think of like when you invest internationally, right? You invest in different countries, potentially, whether it's the UK, Italy, France, doesn't matter. If you look at Texas as a standalone, most people think of the US as a whole, but take Texas as a standalone. It's the 8th largest economy in the world. So it's larger than if you bought a Mexican ETF or an Italian ETF. That's one. Two, the companies have the advantage of being headquartered here, and they're coming here in droves because there's no state income tax on corporations, and there's no state income tax on the individuals either. Now, if you live here, we know that, right? But it's really hard to change because the governor has repeatedly said it's written into the Constitution. So if it's written into the state's constitution, that's a really difficult process to change down the line. So it gives companies an advantage, a tailwind. Now, look, we talked about this. I'm a newer resident of the state. We talked about my apartment. My apartment in any other city would cost anywhere from 2 to 6 times what it cost. Whether you look at New York, Chicago, LA, San Francisco, it's cheaper to live. So there's a lot more sun than New York for sure, and Chicago, right? And then the West Coast different. They get a lot of sun, but their tax rates are super high. So people want to live here because it's a better cost of living, especially if you're young. What are your goals? You want to travel. You want to see the world. You don't want to spend all of your money living with 3 roommates in New York and like not being able to go anywhere.
Yeah. And so on that point, so to follow up then, when we're looking at economic cycles, I'm assuming what your theory here is, or your thesis is, that Texas is better positioned through even a down cycle at a national level than, say, everywhere else. And interestingly, this morning, I was looking at the unemployment data that came out last week, and I drilled down by state. And you could see California now is over 5% unemployment, whereas Texas is at 3.9 as of last month's publication on BLS.
Yeah. And there's several reasons for that. One is there's tons of people leaving California coming here, right? But two, there's so many employment opportunities here. Even if you go back to the let's go through the pandemic, if you were up north, you saw a lot of help wanted signs in places. There wasn't a lot of people there to take the jobs. It's because they all moved down here. They moved to Texas, they moved to Florida, and there just wasn't enough people who wanted to do those jobs or who could do those jobs. And so Texas has been growing, benefiting from people moving. People still, it's the largest state people move to still, right? The largest places they move from are California, New York, and ironically, Florida. Maybe they want to be hotter. I'm not sure. But when you have all those people coming in, all those companies, they can benefit from a cheaper labor pool, a more diverse labor pool. They don't have to pay as much. Think of just the cost difference between here and New York alone, what companies have to pay. What are the two biggest expenses for a corporation? It's employment, which is always number one, and taxes. So if you take out the taxes, okay, they're still federal, but you take out some of it, and you can lower employment costs, and depending on where you are, it can be 55 to 70% of your overall budget. Well, if you can get it closer to 55, seems to be a benefit for the employee who has a better cost of living, better living environment, and the companies can reinvest more of their money back into. And where it really benefits, it's not all those large cap companies that are global. It's the small cap ones that may only operate within the state or within 6 states or 8 states. They're the ones saving the money who are really reinvesting back into growth.
Yeah. And so, I think there's this big myth out there for those that don't live in Texas. There's this perception of what Texas is. And people think maybe Texas is just oil and gas. And it's not true. I think our economy is so diversified right now. And I think, if I'm not mistaken, you probably know this better than I do, oil and gas now less than 10% of the...
So we classify it as energy.
Energy, sorry.
So we classify it as energy. When you look at our large cap index, it's the easiest break. Energy is the second largest sector, ironically behind consumer discretion. Consumer discretion is where Tesla falls, but even if Tesla wasn't there, it would still be the largest sector. So consumer discretion tends to be the largest rebalance sector every quarter, followed by energy. And then you have others. We have a bunch of sectors over 10%, like real estate, healthcare. The one that creates the most diversification is our information technology is lower. It's growing, but it's lower. And so because it's not a huge impact on the economy, for anyone who owns the Magnificent Seven or whatever term you want to call them, everyone owns some of them, one or more. It creates a diversifier away from them.
Okay.
In some way, shape, or form.
Okay. Now, so we were out there for the launch of this particular fund.
Small cap one,
but
yeah.
you have two other ones, right?
Yeah. So we have a large cap version, which is constructed the same way. The only difference is there's no top cutoff, meaning top 800 or whatever. And we've set a bigger bottom. So you have to have $250 million market cap float. And the other one is you have to trade $3 million ADV versus $1 million on the rebalance date. So what's great about the way we set it up is any public company that moves here will be potentially included in the next quarter as long as they meet that criteria, which is pretty simple for a lot of large companies. And then any company leaving will automatically come out. So it's a pretty quick setup. Now for the other one, again, we did something unique. For the oil product, it really has a good correlation to West Texas Intermediate, which has become more of a standard for oil around the world. I mean, just think of, I believe, I might be wrong on this, but Texas was allowed to start exporting WTI around 2014, 2015. It's more of a standard of oil around the world. I mean, Texas is the largest exporter in the U.S. and fourth largest oil producer in the world and largest in the oil producer in the U.S. So it just tells you how that can change an economy. And so this product is designed to track what the Railroad Commission publishes. I know that sounds shocking, Railroad Commission. I was like, there's still a Railroad Commission? But they publish how much oil and gas companies pull out of the ground. And so every year we weight those companies by how much they pull out of the ground. So the largest producer, sort of driller in the state is Diamondback. So they make up about 8% of the index. There's only 32 companies-ish in that range right now, and 4 of them are international. There's 2 Japanese companies and 2 UK companies in the index. And so every year it'll reconstitute based on the Railroad Commission's report, and then every quarter it will rebalance back to what they said.
Okay, now you're talking about West Texas. That's Jack's old stomping grounds.
Right.
Jack got his start out of, so here's a connection for you. So Jack actually went to law school in Illinois, right? In Champaign.
Okay.
And his first job was out in Midland or
Odessa.
Odessa, that's right, in Odessa. So Jack knows all about West Texas.
Yeah.
How was your time there?
Oh, it was great. I mean, you learn a lot about the industry, but I mean, you could see why oil and gas is such a valuable thing there, not just because it's there and it was trapped there, millions of years, or as a result of millions of years of evolution or whatever, however you want to call it. But it's the desert. So to me, it's a natural place to want to go drill. There's not like a ton to screw up.
Yeah.
So you're saying it's hot.
Yeah.
It's very hot.
It's hot, but I mean, when you ever fly out there, you just see, rig after rig, area after area of opportunity for drilling, or people are trying to drill. Yeah.
Just random nodding donkeys.
Yeah.
Yeah.
So what I really like about what you guys have been doing is how you guys have uniquely positioned your product and your brand. This whole thematic, Texas theme, Texas based. But part of the challenge I would assume you have is people automatically say, "Oh, okay, it's a play on Texas." But you guys really differentiate. It's not just the theme of Texas, but there's some benefits which you've talked about. And so, how hard is it to get past that? And how do you deal with that?
So, I mean, we'll start with we are unapologetically Texas, right? We are what we are. But how do we get past it? When you name a fund Texas Equity, right? And then Texas Small Cap Equity, which tickers are TXS and TXSS, and then Texas Oil, which the ticker's OILT, people immediately go to something different than what they're intended. They view it as a niche product, as you said.
Right.
But if I had called it companies that pay cheaper labor and don't pay state income tax, now that's a hell of a name. I don't know who would want that on their statement. But if I had called it that, your investment thesis would be, your mindset would be different on the investment thesis. And so it's overcoming just a natural mindset of what people think to define how they fit. So TXS really doesn't compete with large cap. It could. It's what you would describe as a large mid cap or a small large cap. But when you're set up with Texas in the name, the first question people want to know is, well, what do I do with it, or how do I use it? Right? And there's a million different ways to use it and put it in a portfolio. And then you go to Texas Oil. Well, you worked out there. So what's the biggest thing happening now? So, I mean, my Uber over here was an EV, right? But how much oil it took to produce that EV, people don't think about. They just go, oh, there's no gas. But gas is a byproduct of oil production. So whether we lessen our dependency on gas cars just means they're going to figure out some other use for that gasoline or that byproduct from when they refine oil. So you have to get over those mindsets of what people think. And it's just a connotation about Texas. I'm going to use my sister as an example. She's always like, why would I want to go to Texas? It's whatever. And she came out and spent a week with me in Dallas. She's like, I love this place. Right? It's a very different feel once you get here than what you have in your head. And that's probably said for every state. But once you get over sort of the connotation of what Texas is or what political is, which is not what we're trying to be, we're trying to really have an investment thesis. And the investment thesis centers on, if you pick a state that really supports business, and whether you like Governor Abbott or hate him, Texas has grown in business under his leadership every single year. And it continues to grow. And that's what we're trying to take advantage of. How do you take advantage of where you're headquartered? Does it really matter? And if you look at the performance over long term, those little influences can matter in returns over time.
Yeah. And so let's say we get past someone's initial bias of the name and what it really does. One of the, I'm assuming, objections that you're going to get right off the bat, or not an objection, but more of a clarifying question is, okay, fantastic, but it's such a small cap, and is there liquidity? How do you get over that?
So I'm going to address each one separately, right? So let's say, Avo, you run a large business and you want to buy, I don't know, 100 million of TXS, right? It's a $22 million fund today. You're like, well, I can't own 80% of it or 90% of it. My question is, why not? And the general answer that people give me is, well, if I own that much, it means I'm being impacted by the other shareholders. But that's really a mutual fund mindset. ETFs aren't impacted by any other shareholders because all the trading happens in the secondary market. If any money needs to come into the fund or come out, it happens in kind through a process called creation redemption. So what that does is that means there's no trading. So you owning 80% of it or you owning 80% of it has no impact on the fund whatsoever, because as a portfolio manager, I'm not going out and buying and selling securities on a regular basis. What I'm trying to do is track an index. And as a PM, I may do things for the benefit of all shareholders, like take a loss so the fund doesn't pay a gain later. Now, if we go to volume, so I know I was joking around with you earlier about some statistics, but I'm going to throw them out here. So raise your hand if you knew that 8% of all ETFs make up 90% of all the ETF volume on the exchange, which is about 1/3 across all the exchanges. So it's 1/3 of all traded volume for ETFs, and only 8% of the ETFs make up 90% of that volume. That's crazy.
Yeah.
Right? It's almost 30% of the market is by 8% of the ETFs out there, which is what, 220 ETFs, 240, somewhere in that neighborhood. 65% of all ETFs trade less than 50,000 shares a day. That's a huge number. And that's because they're not they're not basic indexes that people use to gain exposure, right? Or there's options against, or people use as hedging vehicles, or we even talked about hedge funds for a minute. Hedge funds will jump in and out of these for cash equitization or use them to gain exposure to specific areas they want to get. The bottom side is more the active strategies, the newer strategies, the more diverse strategies, and the differentiated strategies. And you can get in and out of those easily. So the example I'm going to use is TXS. Right. First thing is it trades probably 5,000 shares a day today. All right. I want to buy 20,000 shares. How do I do it? Well, if you're going through like Schwab, Fidelity, Pershing, which is where they are today, they all have block desks designed for this. So you can put your order in, make a phone call to that desk. Your trade will get executed in under 3 minutes. People think, oh, it'll take a couple days because there's no liquidity. The ETF's liquidity has nothing to do with what you see on the screen and what it's traded. That's what has traded, not what could have traded. We're going to get into something called implied liquidity. It's a number that looks through the ETF to the underlying securities. That's how much could have traded, right? So these block desks can go out there and get an execution in 3 minutes or less. Some of them will do it in a minute. And a lot of times you'll see the trade will happen on the ask, or it could price improve under the ask because you're getting them involved. And if you're an investor or if you're an RIA running a business, think about the impact of spending those extra 3 minutes. You're adding return to your portfolio by actually engaging an institutional or block desk. That's great. So on $25, if I improve by $25 share price, if I improve by 2 cents, we do the math, if it was $100, it'd be 8 basis points. So I'm adding 8 basis points of return just by spending a few minutes. That's pretty good. Yeah. And the same goes on the sell side. If I sell and get above the bid, I'm adding more return. So by spending those extra few minutes and using the block desk, you really can get better execution across the board. And the real truth is every ETF is as liquid as the underlyings. I can give you a funny imagery if you want to think about it.
Yeah, please.
Think about it this way. If you put a market order in for 50,000 shares, I was watching Sunday Night Baseball on the way here, right? Imagine playing that game without a catcher. Every pitch, where's it going to go?
The back.
Correct. And it's going to bounce around and you have no idea. That is literally what doing a giant market order is on one of these securities. But because of the ETF creation redemption process, if you trade correctly, you always have a backstop. That catcher is always there. No matter what crazy thing you try to do, that institutional block desk will correct it, help you through it, and get the best execution for you. Catcher is going to block everything.
Yeah. You mentioned something earlier talking about how it's a mutual fund mindset. And just for simplification purposes, can you just give us a overview on the main differences between an ETF and a mutual fund?
Yes. So let's start out with they're both open-ended, right? A mutual fund only trades once a day. No matter what time you put your order in, as long as it's before 4 Eastern, you get that price. If you happen to be after 4 Eastern, you get the next day's price. For an ETF, you can trade pretty liquidly anytime between 9:30 and 4. That means there's 23,000, what is it, 400 or 800 seconds in a market day, somewhere in that number. You guys will correct my math. But that means I can trade every one of those seconds that it's open. That's the first thing. The second thing is the consolidated tapes actually start quoting at 4 a.m. in the morning and stop at 8 p.m. In theory, I can actually trade that entire window. Once the market's closed, it's pretty illiquid, but I can still do it if I want to. I see pre-market trades all the time in ETFs. Still don't know why, but I see them. It's a different story. Then other differences. So the creation redemption process is an in-kind process, and it happens in units for an ETF. So Oil T, for example, is 5,000 shares at base. We'll just round it. It's like $28, but we'll say 25. That's $125,000 in or out. TXS and TXSS are 10,000. Again, we'll use $25. That's 250,000, even though they're a little bit more or a little less. That's the amount that can come in or come out, and it's only a few firms that can do that. They're called authorized participants, and they have to sign an agreement in order to have that, to be part of that process. So not everyone can do it. With a mutual fund, technically every dollar you buy could be a creation. Every dollar you sell could be a redemption. So mutual funds have to keep cash on hand to meet that. And if they get a large buy, they have to buy a lot of securities. And if they get a large sell, they have to sell a lot of securities. So it's not like you as the investor, if you did a $10,000 redemption, you'd like, hey, here's these 20 securities. You're excited about it. You'd be annoyed. You just want the cash. So mutual funds do have the same ability to do the in-kind process that ETFs have. They just choose not to use it. And that's the biggest difference. And that's why ETFs have been significantly more cost-effective from a capital gains perspective. Now, the other thing, in the US, the ETF industry started in 93. Mutual fund industry started in 1929. So the mutual fund fees have been significantly higher for a longer period of time. So they've come down, but not nearly what ETFs started out much lower. And so they've come down and gotten much cheaper. So there's a cost differential to a lot of them as well.
Yeah. You know what this reminds me of? I'm going to share a story when we were in New York. So Jack and I got there, was it Sunday night, I believe?
Right.
And there was about 9 o'clock, 9:30 at night. And we were trying to get a ride to the city. And this was in LaGuardia. And it was crazy line. I mean, there were just tons of people. We went outside. It was chilly, actually. And we went on Uber app, and it was like $120 to the city. And Jack checked his Lyft, and it was $60. But what we found out is all the Lyft drivers were also doing Uber driving, and they're like, well, why are we going to get paid half if we're going to get paid twice as much? So we wait there, and took about 20 minutes. And I started thinking, I said, well, wait a minute. You know, I'm of a certain age. I'm a little older than Jack. I'm probably closer to your age. And I said, hey, there are these things called taxi cabs. Remember taxi cabs? So we walked back there. The line was 3 minutes. $60 later, we were in the city. And so I you know, to kind of bring this back to your point, it's you have a dominant industry where people are just used to it. So all these kids just sitting there on their phones, staring at Uber, waiting, they don't realize there's another option out there. And you and I were talking earlier about, you know, when you're in a crowded space like the one you're in, you're either going to differentiate yourself by product or service.
Yeah. And so what we were talking about was, so I have neighbors that retired. They went to when they wanted to take their 401k and go to different RIAs to see what they would recommend. So they went to 3 different RIAs, and she asked me if she could show it to me. And I'm like, sure. And what she showed me was all 3 used the exact same ETFs from the same 3 firms, minus there was one holding that was different. One had a real estate holding, one had preferred, and one of them had something else for income that I can't remember. But when you really think about that, if you're using all the same products, and those products are also used by the robos, how are you differentiating as an RIA to earn your fee? You know, a lot of them charge 1% or whatever it is to manage money. Well, you can do it by service, as we said. You know, I talked to one who likes to take everyone car shopping when they need a car. All right, that's a differentiated service. Maybe people like that. I would hate it, but others, you can differentiate by using different products to create an outperformance, right? Because you're not always going to outperform by asset allocation. Your capital market assumptions are not always going to be right. So you can gain an advantage by using different ETFs or a different product, in a sense, to do that. And we talked about 65% of all ETFs trade less than 50,000 shares a day. There's also a ton of ETFs that are under 100 million, right? Those are the ones that aren't the trading vehicles. They're the buy and hold. That's why they don't trade as much. So you can leverage into them and differentiate your portfolio and get just as good, if not better, returns as some of the other things you're using. But again, it comes down to how you want to differentiate your practice. And there's a fear out there. So I was talking about, we have access to a database there's 1 million RAs, or advisors, I should say, across the country. I would bet 80% of them manage money almost the exact same way. So how do you really differentiate? How do you keep it from going from you to someone else, to someone else, to someone else? And it's either going to be service or product. What else can it be? I mean, think about the stores you shop at or the restaurants you go to. A lot of them serve the same type of food. It's just a question of what you really like and why is that restaurant differentiated. It's going to be service or how good that product is.
Yeah. And you know, for the listeners of this show, Middle Market Companies, I think there's a lot of lessons to be learned about how you guys have been able to, you know, differentiate yourself, especially, you know, in banking, let's call it, right? Where, okay, bank's a bank, right? But you guys have done such a wonderful job of carving out not just a niche with the play on Texas, but also differentiating through your products. But the thing that I was most impressed with, and I got to tell you, is the access that you guys have given to folks. For me, being able to talk to you and your colleagues, and being able to just pick up the phone and call anybody I want, and being receptive, I thought that was a great lesson in how you could be big, but you could still learn or still deliver the customer service, because it's so difficult these days. You pick up the phone, you call any bank, and you're on hold, and it's kind of refreshing to be able to talk to people.
And think about my role, right? Running the business. I'm out there all the time. Like you saw me in New York. I'm constantly on the road talking to advisors, talking to people. How many other firms have people in my position that are out there doing that? They don't have access to it because they think they're too important. Truth is, we're all people, right? And going out there to talk to you about how to use it or what makes sense, whether it's me or my head of sales or our other salespeople, we're available. That's the whole idea. We're not too big to do X or too small to do Y. We just want to have the conversations and understand how you want to run your business and how we can help.
Yeah. So I want to talk about one more thing, and that is you guys have something else coming up later on this year at the New York Stock Exchange.
Hopefully. Yes, trying to get another bell ring.
Okay, so that's not set in stone yet?
No. So we've asked. So I'm pretty sure we'll get one. My target was to do it in late August, but that doesn't mean the exchange will accommodate. They have their own schedule.
Yeah. Now, is this fund is ready to go? Is this a new fund?
It's going to celebrate oil tea.
It's going to celebrate oil tea. Okay.
Yeah.
Okay.
So
fantastic.
when you think about what we just did, right? So in September of last year, the Governor Abbott rang the bell at the New York for TXS. You came out for the NASDAQ one. It was April 8th to celebrate TXSS. We still have one more to celebrate.
Okay.
So we're going to try to do a bell later this year to celebrate that. And hopefully, as we gain more assets, we're going to file for more funds and we'll just have more celebrations.
Oh, one big party. One big party.
I mean, the truth is, it really comes down to you guys, the investor. That's what we're building this for, to create product that is different than what exists today, to offer you access, not just to the state of Texas, but to differentiated product that can really add value to the portfolio over the long run.
Yeah.
And we want to celebrate that with you guys, not just with us. We're not doing it for us. We're doing it for you.
Yeah. And I think that is so awesome. I had a practice management coach years ago. He said to me, you should spend 80% of your marketing dollars on your existing customers. And I thought it was so profound. The idea there being that these are people that already know you, but ultimately these are the people that are paying you. You should take care of them and turn them into advocates. And I don't want to go into this story, but you see so many times now, if you have let's say you have an energy plan that you're trying to switch, they'll offer cheaper rates to new customers at the expense of the loyal customers. And I think that is a terrible lesson, for business owners to follow. And I think, what you guys are doing with access and taking care of people and being there for them is just fantastic.
Yeah. And thank you. That's really what we want to be here for. We're never going to be too big for you to have access, no matter how big we get. And we're never going to be, too frantic or too small to really get back to you and service you. We're always going to be just right so that we can take care of the client. Because it's not about us. It doesn't matter what we think. It matters what you think and how and if you use our products.
Yeah. And on that note, I think that's a wonderful message for all business owners out there. And thanks, Ed. Thanks for coming in.
Yeah, thank you for having me. I'm enjoying Houston so far.
All right.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.